Gold and silver markets are not simply pulling back anymore. What we are witnessing right now looks increasingly like a full-scale market collapse unfolding in real time. And it is happening as investors around the world watch their screens in disbelief. At the time this report is being recorded, gold had already broken below the 4,600 level, and silver had plunged towards 72. And the situation wasn't stabilizing. Every refresh brought new lows, 4,550, then 4,520, and moments later, even weaker levels. Traders hoping for a bounce instead saw prices continuing to fall with almost no resistance. Only days ago, many believed the worst was already behind us. Last Friday delivered one of the sharpest single-day declines in precious metals markets in decades. Silver experienced a historic drop, while gold suffered a heavy sell-off of its own. Social media, trading forums, and even some analysts declared that the market had finally exhausted sellers. The general belief was simple: the bottom was in. But what is happening now shows that assumption may have been dangerously premature. This is no longer ordinary profit-taking. This is not cautious repositioning. What markets are now experiencing is forced liquidation, positions being closed automatically as traders fail to meet margin requirements. Accounts are being drained position by position as exchanges liquidate holdings to protect themselves from mounting losses. And most alarming of all, the selling pressure is not slowing. It is accelerating. In this report, we're going to break down what is actually driving this collapse, why it continues to intensify, and how market mechanics, not just investor fear, are pushing prices lower. Because what we are seeing is not just panic. It is structural pressure inside the trading system itself. Earlier this morning, as markets reopened after the weekend, another disturbing development unfolded. Thousands of traders attempted to sell their silver exchange-traded fund positions, hoping to exit before losses grew worse. But many of them couldn't. Orders were rejected. Trading systems returned error messages. Some platforms simply refused to process sell orders at all. The reason? Circuit limits had already been breached. Friday's violent drop pushed prices so far down that current trading levels remained outside permitted exchange ranges. That meant traders who held positions over the weekend, hoping to escape Monday morning, suddenly found themselves trapped. They could not sell at any price. Imagine watching prices collapse while your sell button simply doesn't work. Refreshing the screen again and again, calling brokers, waiting on hold, watching account balances shrink minute by minute, unable to do anything. And all the while, gold kept sliding toward 4,500, and silver pushed through the low 70s. The next logical question becomes unavoidable. What triggered this chain reaction in the first place? The answer centers on one critical mechanism inside futures markets: margin requirements. To understand what is happening, we need to understand how leverage works. When traders buy futures contracts, they do not pay the full value of the metal. Instead, they put down a deposit, often around 10% of the total contract value. This deposit is called margin. It allows traders to control large positions with relatively small amounts of capital. For example, controlling $100,000 worth of silver might require only $10,000 upfront. That leverage amplifies gains, but it also magnifies losses. And here is where things become dangerous. If the exchange suddenly increases margin requirements, traders must immediately deposit additional cash to maintain their positions. Not next week, not after funds clear. Immediately. If they cannot provide the money, the exchange liquidates their positions automatically, selling at whatever price exists at that moment. And when thousands of traders are forced to liquidate at the same time, prices collapse even faster. One margin increase is painful but survivable. Many traders keep extra capital ready for emergencies. But what happens when margin requirements are raised again and again and again? At that point, survival becomes nearly impossible. And that is exactly what has happened over the past 2 months. The Chicago Mercantile Exchange, which oversees major futures trading, has implemented multiple margin hikes in rapid succession. Each increase forced traders to commit more capital or face liquidation. Just as markets tried to stabilize, another hike arrived. Then another. Traders barely had time to recover before new demands appeared. And then came the most aggressive move yet. Margin requirements were tied directly to price movement. As prices rose, required deposits automatically increased, meaning traders needed more cash even if they made no changes to their positions. The system effectively tightened around them. And after Friday's collapse, margin increases did not stop. Additional hikes were introduced again this week, adding even more pressure. Compare this to normal conditions. In many previous years, exchanges implemented only 2 or 3 margin changes in an entire year. Now traders have faced multiple increases in just weeks. Each hike triggers forced selling. Falling prices then trigger additional margin calls for traders who weren't initially affected. More forced selling follows. Prices drop further. More accounts get liquidated. A cascading death spiral. And that spiral is what investors are watching right now unfold in precious metals markets. Gold near 4,500. Silver near 72. Selling intensifying. But here is the development that truly alarmed market observers overnight. On the very same day margin requirements increased in Chicago, the Shanghai Gold Exchange also raised margin requirements. 2 exchanges located 14 time zones apart. 2 separate financial systems. Yet both moved in the same direction on the same day. Under normal circumstances, that alignment would be unusual. The United States and China rarely coordinate market actions. Yet here they were, implementing parallel policies simultaneously. Which raises a troubling question. Are both sides reacting to the same hidden risk? And if so, what exactly are they worried about? To understand what may truly be driving this crisis, we need to look beyond price charts, and it is something most everyday investors rarely think about: the difference between paper silver and physical silver. Because right now, that gap may be at the center of everything happening in the market. In futures markets, contracts representing silver are traded constantly. These contracts promise delivery of metal at a future date, but in reality, the overwhelming majority are settled in cash. Very little actual silver changes hands. This works fine as long as traders are satisfied settling their profits or losses in dollars. But the entire system depends on one assumption: that not everyone will demand physical delivery at the same time. And lately, that assumption may be breaking down. Recent exchange data shows that enormous quantities of physical silver have been leaving storage vaults at an accelerating pace. Not traded on paper, not moved electronically, physically removed. Truck by truck, shipment by shipment. Industry analysts estimate that tens of millions of ounces exited exchange vaults within just weeks. Over the past several years, total inventories have dropped significantly from previous highs, and the speed of withdrawal appears to be increasing. The obvious question becomes, who is taking this metal? It's not retail investors. Transporting massive amounts of silver requires logistics, insurance, secure storage, and industrial use cases. This is large institutional money. Manufacturers, sovereign wealth funds, strategic buyers securing supply. And the timing matters, because the next major futures delivery window approaches soon. During that period, traders holding contracts must choose whether to settle in cash or demand physical delivery. If only a small percentage of contract holders request metal instead of cash, exchange inventories could face extreme pressure. And that possibility may explain why margin requirements are being raised so aggressively. The goal, some analysts argue, is to reduce the number of traders still holding long positions before delivery requests expose inventory limitations. And so far, the strategy appears to be working. Prices are collapsing. Traders are being forced out. Long positions are shrinking under pressure. But here's the detail keeping some market observers awake at night. Despite the crash in futures markets, physical silver prices in parts of Asia have remained significantly higher than paper prices in New York. In other words, while futures contracts show silver trading near the low $70 range, actual physical metal transactions elsewhere have reportedly occurred at noticeably higher prices. Under normal market conditions, such gaps do not persist. Arbitrage traders quickly exploit price differences, bringing markets back into alignment. But this time, the divergence has not closed. And that raises uncomfortable questions. If silver were truly worth the lower futures price, why would industrial buyers pay more elsewhere? Why would manufacturers, who consume massive quantities, willingly pay premiums if cheaper supply were easily available? Some analysts argue this suggests the paper market price may not fully reflect physical supply realities. Others say logistics, regional supply chains, and currency factors could explain temporary price gaps. Either way, the divergence is unusual, and unusual conditions often signal stress inside the system. Meanwhile, large financial institutions that maintain short positions in metals markets are benefiting from falling prices. When silver drops, those betting against the metal profit. This does not automatically imply wrongdoing. Short selling is legal and common in commodities markets. But it does raise questions about who benefits most from sudden price collapses. And timing also matters. Just before the sharp sell-off began, reports circulated suggesting possible policy changes regarding strategic metal stockpiles. Automated trading algorithms reacted instantly, triggering sell orders. Hours later, officials disputed those reports, but by then markets had already plunged. Once automated systems start selling, corrections rarely undo the damage immediately. Adding further intrigue, unusual options trading activity appeared shortly before prices fell. Large bets were placed anticipating a major silver decline. Whether that reflects lucky speculation or informed positioning remains unknown. But events like this fuel suspicion among market participants already shaken by rapid losses. And then came another shock. Some trading platforms experienced disruptions during peak volatility. Certain funds temporarily halted trading. Investors attempting to exit positions found themselves unable to execute orders. Imagine watching prices collapse while being unable to sell. For some traders, that scenario became reality. Leveraged funds tied to silver experienced dramatic losses. In some cases, portfolios lost more than half their value in a single session. Phone lines at brokerages became overwhelmed. Online systems lagged or froze. Traders reported long waits and inconsistent account access. And for those caught on the wrong side of the move, losses compounded quickly. First prices crashed. Then exits became difficult. Then margin requirements increased again. It was, for many investors, the worst possible sequence of events. But here's the paradox. While futures prices collapse, the broader fundamental picture for silver hasn't necessarily weakened. Industrial demand remains strong. Solar panels, electric vehicles, electronics manufacturing, and new technologies continue consuming large amounts of silver. Supply growth, meanwhile, has struggled to keep pace in recent years. Some analysts argue the long-term fundamentals remain supportive even as short-term price action turns brutal, which creates confusion for investors. How can prices collapse if demand remains strong? The answer may lie in the difference between short-term financial positioning and long-term physical supply. Right now, paper markets are driving price discovery, but physical supply dynamics do not change overnight. And that tension between financial markets and real-world demand is now colliding in dramatic fashion. So the critical question becomes, what happens next? Where does this crash actually end? And more importantly, who survives long enough to benefit when stability returns? At this stage of the sell-off, predicting an exact bottom would be irresponsible. In crashes like this, traditional support levels often break faster than analysts expect, and price targets quickly become meaningless. What matters more than guessing the bottom is understanding the signals that reveal whether the crisis is ending or getting worse. And several key indicators are now flashing warnings across the market. First, watch the difference between futures prices and physical market premiums. As long as physical buyers continue paying significantly more than futures prices suggest, it indicates real demand has not disappeared. If both physical and paper prices collapse together, that would suggest demand itself is weakening. But if physical prices remain firm while futures continue falling, the disconnect becomes harder to ignore. Second, attention is turning toward exchange vault inventories. Each week, updated figures reveal how much metal remains available inside major storage facilities. Recent reports show continued withdrawals of physical silver, even as prices decline. That creates a puzzling contradiction. If prices are crashing, why are large buyers still removing metal from vaults? Normally, falling prices reduce urgency to buy. But if withdrawals continue despite lower prices, it suggests some institutions are more concerned about securing supply than timing the perfect price. And that behavior tells us something important. Not everyone believes this price collapse reflects long-term reality. Third, lease rates for physical silver have spiked. Lease rates represent the cost institutions pay to borrow physical metal. Under normal conditions, Those rates remain low because supply is easily available. But when borrowing costs rise sharply, it signals difficulty obtaining metal. In past market cycles, spikes in lease rates often preceded major price moves or supply disruptions. Institutions don't pay high borrowing costs unless they urgently need the material. Fourth, traders are closely watching open interest in upcoming futures contracts. Open interest measures how many positions remain active. If traders panic and close positions, open interest falls sharply. But if open interest stays elevated despite falling prices, it means some traders are still holding positions, possibly expecting eventual recovery or physical delivery. High open interest approaching delivery deadlines increases pressure on exchanges because more participants may request actual metal. And finally, market stability itself has become an indicator. When trading platforms experience outages, funds halt withdrawals, or investors struggle to access accounts, it signals stress inside the system. Healthy markets process transactions smoothly, even during volatility. But when systems freeze under pressure, it suggests deeper structural strain. And recent disruptions have left many investors uneasy. Beyond technical indicators, however, lies the broader economic reality. Because despite the dramatic crash in prices, the underlying demand picture for silver and gold has not suddenly vanished. Silver remains critical for renewable energy production, electronics manufacturing, and advanced technologies. Electric vehicles, solar panels, data centers, and semiconductor production all depend heavily on silver. At the same time, mining production has not dramatically increased. Building new mines takes years, not months. And geopolitical developments have further complicated supply chains, with some producing nations introducing export restrictions or prioritizing domestic use. So investors are now caught between two conflicting forces. On one side, financial markets are experiencing forced selling, leverage unwinds, and margin-driven liquidation. On the other side, long-term industrial demand continues to grow. This clash creates enormous uncertainty, and uncertainty creates volatility. Meanwhile, outside the trading floors, real economic damage is already visible. Precious metals businesses in multiple countries are reporting financial strain after sudden price swings wiped out hedged positions. Some trading firms have declared bankruptcy. Investment funds have temporarily frozen withdrawals. Dealers in several markets report difficulty sourcing physical metal even as futures prices drop. It's a reminder that crashes don't just impact traders. They ripple through entire industries. And yet, history shows something important. Market crashes don't erase wealth. They transfer it. When panic forces one group to sell, another group buys. When leveraged traders are liquidated, stronger balance sheets step in. The key difference between winners and losers often isn't prediction, it's survival. Those who manage risk effectively survive volatility. Those who overextend often don't. Which brings us back to the critical question facing investors right now. What happens when financial market prices eventually reconnect with physical market realities? Because over long periods, those two forces tend to converge. Paper contracts can be created endlessly. Physical metal cannot. Eventually, prices reflect supply and demand fundamentals again. But the path to that convergence can be painful and unpredictable. So now investors are watching carefully. Not just prices, but signals beneath the surface. Because the next move may not simply determine profits or losses. It may determine who remains in the market when stability finally returns. So where does all of this leave investors now? At this moment, markets are caught between fear and fundamentals, between forced selling and long-term demand. Prices are falling, confidence is shaken, and many traders are questioning whether the worst is over or still ahead. The truth is, crashes rarely end in a clean, predictable way. They end when selling pressure finally exhausts itself, when leverage has been flushed out, when weak positions are gone and only those with capital and patience remain. And right now, that process still appears to be underway. What investors must understand is that markets do not simply move based on logic in the short term. They move based on liquidity. When liquidity disappears, prices can move far beyond what fundamentals alone would justify. And that's exactly what forced liquidations create. A trader might believe silver should be higher based on supply shortages. But if that trader cannot meet margin requirements, belief doesn't matter. Positions get liquidated anyway. Multiply that situation across thousands of traders, and prices collapse regardless of long-term outlook. But history also teaches another lesson. Moments of extreme panic often create opportunities for those who remain financially and emotionally stable. Every major crash eventually reaches a point where selling slows, confidence gradually rebuilds, and markets begin recovering. The challenge is surviving long enough to see that recovery. Right now, several scenarios remain possible. If margin pressures ease and forced selling slows, prices could stabilize and begin rebuilding. Physical demand could gradually pull prices higher again as financial pressure subsides. However, if liquidation continues, prices may still fall further before balance returns. Support levels that seemed strong today can break quickly when fear dominates trading decisions. No one can predict the exact turning point, but investors can prepare themselves for volatility rather than assuming it's over. Risk management, position sizing, and patience matter more during crashes than bold predictions, because markets reward survival first and timing second. And perhaps the biggest lesson from this episode is how interconnected global markets have become. Actions in one exchange ripple across continents within minutes. Margin changes, algorithmic trading, institutional positioning, all combine to create movements that feel sudden and overwhelming to everyday investors. And when panic spreads, it spreads globally. But markets also have a way of correcting extremes. Paper prices and physical demand cannot stay disconnected forever. Eventually, financial markets realign with real-world supply and consumption. The only question is how much damage occurs before that happens. And that is why investors must ask themselves difficult questions right now. Do you truly understand the risks you are taking? Is your exposure manageable if prices fall further? Do you have a plan, or are you reacting emotionally to every move? Because in crashes like this, the difference between survival and disaster often comes down to preparation. The traders who endure are not necessarily the smartest or the luckiest. They are the ones who manage risk, stay disciplined, and avoid emotional decisions while others panic. Markets will eventually stabilize. They always do. But until they do, volatility remains the dominant force. So as gold struggles near critical levels and silver continues facing heavy pressure, investors must focus less on predicting tomorrow's price and more on protecting their ability to participate when clarity finally returns. Because when the dust settles, opportunities always emerge. The question is simple. Will you still be standing when they do? That's all for today's market breakdown. Share your thoughts below about where you think gold and silver go from here. And stay tuned as we continue tracking developments in this unfolding market story. We'll continue following the situation closely. Stay safe in the markets, and we'll see you in the next report.